This is it, the question that I get asked the most, and that is, what is the better investment, shares versus real estate? In this video, we're going to talk about the pros and cons of investing in both of these. And at the end of the video, we're going to go through some numbers over the long term to work out what is the better investment for you. So let's do it. All right, so a few things we need to clear up first. As always, all the information in all of my videos should be considered general information only. It's not to be considered financial advice. The second thing is, I know there is a lot of ways in which you can make a ton of money in both of these, shares and real estate, but for the sake of the video and for making it as simple and as easy for everyone to follow, we're gonna compare just general averages here. An investor that's put their money into an ETF, an investor that's bought in a very average location, so you guys can make your decision for yourself as to what might be the best investment for you. All right, so let's talk about the pros and cons of investing in real estate. So the first advantage of investing in real estate is the fact that you can use leverage. Now, this is essentially using other people's money to go and make more money. So for example, every dollar that you have, the bank is gonna basically lend you up to $4. Now, of course, that's depending on your personal circumstances, but as a general rule of thumb, that's what you can expect. To go and make more money using other people's money, this is one of the greatest advantages of investing in real estate. So the second advantage of investing in real estate is using equity to build wealth. And this is probably one of the greatest wealth building strategies on earth. So for every time your property grows in value, you can basically extract that equity to go and buy another property, and you can just repeat the cycle over and over again until you've amassed the wealth and fortune that you really want. Now, obviously that depends on market conditions. If the market and the area you bought in is not increasing enough in value, you're not gonna have any equity. But generally speaking, over time, after a long period of time, you will have some equity which you can go and use to do whatever you want with, really. This is basically tax-free money. Obviously there's a loan attached to it, but you can use that money to go and do whatever you want with. You can go on a shopping spree, you can buy another property with it, you can go on a holiday, whatever you want. Equity is tax-free money when you use it through a line of credit. Obviously, there's a loan attached to it, so be cautious of that, obviously. And the other advantage of investing in real estate is some of the tax advantages that you can get. Now, it depends on where you are in the world, it depends on your personal circumstances, but generally speaking, if the property's not paying for itself, they call that negatively geared, which means you will get some taxation advantages potentially at the end of the year. That is no way at all taxation advice, but something to consider, that you could reduce your taxable income, and that is an advantage for a lot of people out there. All right, so some of the disadvantages of investing in real estate, and I think it goes without saying here, we all know that you need a deposit to go and buy properties with, so the entry costs into the real estate market are extremely high, multiple tens of thousands of dollars to go and purchase the property. Then you're gonna have to pay a conveyancer, a building and pest inspector, and multiple other things to even enter into the property market. So the entry costs are massive. And likewise, when you go on to sell the property, you're most likely gonna need a real estate agent to do that. Again, you're gonna need a solicitor to do all the paperwork, etc. So exiting out of the real estate market is also extremely expensive. And then once you have the property, the ongoing maintenance of holding that particular property. Now, this is going to vary depending on the age of the property, the location, and a whole range of things, but maintenance items that come up can be a few $100s, can be a few $1,000s, can be tens of thousands of dollars, and I'm not even exaggerating. It just depends on the building and it depends on what goes wrong. So a major disadvantage of investing in real estate is not really knowing what is going to come down the line in terms of costs and maintenance in holding that particular property. So something to consider is the maintenance costs, which can really surprise you at any point. The other disadvantage is that the asset is not very liquid. So if you wanted to sell the property very, very quickly, it's not easy to go and do that. It does take time to put the property on the market, to get people inspecting it, looking at it, to make offers. Then they make an offer, you accept it, there's a settlement period. That takes a long time. So in terms of getting your money back out of the market, something to consider. It's not going to happen very easily. I've actually got quite a list of downsides of investing in real estate. So one of the other ones is tenants. Now, you obviously buy the property, you're going to have to go and find a suitable tenant for that particular property. And that also takes time as well. So you're potentially going to have periods where the property is vacant, you're not earning any rental income from that. You're going to have to pay the mortgage out of your own pocket. Something to consider, and a lot of people look over this, but throughout every year, your property, depending on what kind of tenant you have, your property may be vacant for weeks at a time, and this is something to factor into your own budget when you're working out the expenses, because if no one's living there, no one's paying the bill, no one's paying the rent, so something to factor in as well. And also, while we're on the topic of tenants, if you get a bad tenant, they can vandalize the property. They can do whatever they want. Well, you're not there, you don't know what's happening. So something to consider, someone is living inside your asset and they can do whatever they want really inside that property. Obviously, when you go to inspect it and there's damages, you can, take their bond away. But again, it's a risk that you take having people live inside your asset. It's kind of weird, but it is what it is. And then the final downside of investing in real estate is the fact that the real estate market is going to go through cycles, right? You might buy at the peak of the market, like I did in 2017 in Sydney. The market's going to drop. You are going to lose in value. As long as you don't sell the property, you're not technically losing, but you're not going to get any equity because the property's not growing in value. If unfortunately you do have to sell, that's when you will lose. So, just because you buy real estate doesn't mean you're automatically going to win. It depends on what the market's doing and the market cycle. So obviously you want to time it the best way you can, but again, I know that's not possible. We can't all, see into the future, but something to consider is the downturn in the real estate market. All right, so the pros and cons of investing in an ETF, and the advantages are that investing in an ETF is diversifying your portfolio. So for example, if you buy an ETF that tracks the ASX 200, you're essentially investing in the top 200 companies always. So a great way to diversify your portfolio is by investing in an ETF that tracks an index, and you'll be constantly investing in the best companies that are on the market. Some other advantages is that the low entry costs into buying an ETF, generally you're really going to pay a brokerage fee, 15, 20 bucks maybe, and then you're trading. You've got an ETF and you're good to go, really. And with that being said, it's easy to trade. Like if you want to get out of the market, sell your ETF and pretty much same day you can have your money and away you go. So extremely liquid. It's good to offload the asset. So a great advantage is if you want to get your money back out of the market, you can do so very quickly. And the downsides of investing in an ETF, well, I couldn't really find too many, but if you get into an ETF where they have high commissions, then obviously the commissions is going to eat into your profit. Not very good. And the other downside is when there's a recession, the market obviously drops. Now, again, if you don't sell during the recession, you're not going to technically lose money. But at the same time, if you need to extract your money out of the market while there's a recession, then obviously you're going to lose. So the same disadvantage applies with real estate as investing in the share market. Something to consider is when you enter into the market, you want to hold these investments long term. You don't want to be getting in and selling in the next couple of years. My advice would be if you're investing in an ETF or property, it should really only ever be over the long term, unless you have another strategy, of course. But for the average investor, you want to buy, you want to hold for 10, 15, 20 years to really see some gains out of this. So just don't sell during a recession. Simple as that. All right, so let's go over the numbers. Over a 25-year period, two investors, they're going to start out with $50,000 each. One is going to put their money into an ETF. The other is going to buy a very average Australian house. And then after 25 years, we're going to see where they're at. So let's have a look at what we got here. Okay, so as you can see, there's two investors here. They're starting out with $50,000 each. One is going to put their money into the Vanguard Australian Shares Index. The other is going to buy a very average 3-bedroom house worth $400,000, and they're going to put a 10% deposit down. So obviously, the 10% deposit is going to be $40,000. The extra $10,000 is going to cover all of the entry costs into purchasing that particular property. So fairly even in terms of where these two investors are starting out. Now, the Vanguard Australian Shares Index is actually growing over the past 10 years at 7.17% annually. That's the actual growth rate. And the property investor bought in an area where the average annual growth rate is 4%. Now, 4% is the general average of what you could expect pretty much anywhere in the country. So again, fairly even. I wanted to make this not too biased on either side here. And again, so this is what the average investor could expect investing in both of these asset classes. Average dividend payout for the Vanguard Australian Shares Index is currently 3.55%. So this investor is going to reinvest this dividend year on year, and he's going to see his investment grow over this 25-year period. The real estate investor, he's getting a rental yield of 5% in the area that he bought, which means the property in terms of the mortgage is relatively being paid for. But again, as I said, he's going to have to pay for maintenance and a few other property management fees, etc., that will come up year on year over that 25-year period. And we'll touch on that in just a sec. So after 25 years, what is the value of both of these investments? So as you can see, the ETF investor is going to have an investment that's worth over $637,000. And the individual that's bought the real estate is going to have an investment that's worth $1.66 million. Now, obviously, the ETF investor doesn't have any debt. So that is technically $637,000 worth of equity that this guy would have. If he went and sold that, that would be his cash, and he can go and do whatever he wants with that. The person who's bought the real estate, after 25 years, most likely that debt is going to be gone. But for the sake of the video and making it, I guess, as simple and as fair as possible, your real estate investor is going to have paid property management fees. He's going to have paid maintenance over that time period and a whole host of other costs that may have come up. Now, I know he's probably not going to have paid $350,000 worth of maintenance, but for the sake of the video, let's pretend like he just didn't pay down any of the debt in that time period. What is he left with? He's left with over $716,000. So even factoring that in, you can see here that the real estate investor does come out ahead. And the reason why the real estate investor comes out ahead is, as I said in the start of the video, leverage. This is why the real estate investor turned his $1 into $4. He used the bank's money to go and make more money with, and that's why he came out ahead. He's got more equity at the end of the day than the guy who invested in the ETF. Now, with that being said, I get it. There are many different ways the person investing in the share market could have made much more money than 7.17% over that 25-year period. And likewise, I get it. The real estate investor could have made a ton more money investing in a different area, getting a higher annual capital growth rate. But for the sake of the video, I wanted to make it fair of what the average person would get investing in both of these asset classes. So with that being said, before you invest any of your money into anything, it doesn't matter if it's shares, real estate, whatever, make sure you know exactly what you're getting yourself into and do the right amount of research to make sure that you're comfortable that you're knowing exactly where your money is going. That's all we have time for today's video. I hope you got some value out of that and now know what might be a better investment for you. Until next time, thanks for watching. I'll catch you soon.